So, thank you, Karen. I hope this economic briefing served its purpose to show you that there is indeed a silver lining despite all these challenges we now face. A pleasant afternoon to all the participants, all of you here. I think we achieved a record number of close to 1,500 attendees. So one thing we cannot afford to squander is time, and it's time to turn this crisis into opportunities, turn jitters into winners. Our esteemed speakers raised many important points, which makes us cautiously optimistic, according to Dan, and constructively bullish, according to Christy. Despite some jitters, we remain positive on the markets and can still see winners in the horizon. Why? Because policy and benchmark rates will remain low this year, and the yield curve more or less hovering at a tight range. Inflation will remain manageable, with occasional spikes to be expected. Expect an accommodative monetary policy and fiscal stimulus to support economic growth. Ample domestic liquidity while the offshore markets continue to be accessible to the country. Last year, private companies raised an unprecedented amount of $8 billion in the offshore market. Our GIR is at an all-time high, ably supporting the peso. While OFW remittances have outperformed expectations and has shown resiliency, the IT BPO sector still contributes positively. Our debt to GDP, though increasing, is still at acceptable levels. According to Dr. Abola, we have regained 60% of jobs we lost during the pandemic. Silver linings in the health front. Vaccines have been developed and are being rolled out. Economies are trying to open up or ease restrictions amidst the spread of new and more virulent strain. All these bode well for a conducive equity and bond markets. Consider the following. For issuers in the debt capital market space, pricing is quite competitive, and investors are starting to consider longer tenors for the right price. The equities market saw the advent of REITs. Ali's successful maiden issue yielded investors as much as 30% on a total return basis. 50% of the IPO pipeline this year may well be REITs related, as more real estate companies use this instrument to recycle capital. As a dividend stock with potential for capital appreciation, REITs can definitely be an attractive proposition for investors during a low interest rate environment. The index ended last year at 7,139. At these levels, the market is fairly valued in the sense that we're already at the 5-year average PE of 19 times, but with good upside when looking at the very low long-term PE of 15 times based on 2022 earnings. So pullbacks are seen to be as buying opportunities to position for better times. Again, we forecast the index to end 2021 within the range of 7,800 to 8,100. Why a buoyant 2021 market? Aside from a recovery in corporate earnings, though not quite yet at 2019 levels, we do expect foreign funds to come back. After the exit of as much as $3.8 billion in foreign investments in the stock market in recent years, our market is now underinvested by foreigners. The frothy US markets will make emerging markets, especially Asia, increasingly more attractive. Asia's GDP growth will be above the world average. Despite the pandemic and the downturn in the market, IPOs and other listings in 2020 have done quite well, an encouraging sign for issuers to consider tapping the market in 2021. In the run-up of the market in the last quarter, retail investors were rejuvenated by our brisk online stock trading business at First Metro Securities, which, has one of the best electronic platforms in the market. On the asset management side, those whose risk profile are more flexible, shifting your portfolio to a more aggressive asset allocation with as much as 50% exposure in equities is something worth considering for better yields. Of course, it helps if done with the right fund manager, like First Metro Asset Management. They can suggest various suitable funds for your needs. Likewise, the FMIC's ETF, the first and only ETF in the country, should be a good investment. In closing, we in First Metro remain committed to developing the capital markets for both issuers and investors to benefit from. We will continue to work hard to make the capital markets more efficient, accessible, and equitable to all participants. The capital markets, after all, is a viable alternative not only from the perspective of fundraising, capital formation, and offering better yielding and alternative investments to investors. It has filled in the void that resulted when banks had no choice but to brace up for tough times ahead. Aggressive provisioning, selective lending, and defensive loan pricing have allowed the bond market to become an attractive option for companies. It aided companies to raise much-needed liquidity to tide them over during the crisis. It has bought them valuable time to stay afloat while their businesses recover. Turning jitters into winners. Let's stay focused, not with blinders, but with the use of our peripheral vision so that we don't lose sight of the forest as we navigate through the trees. Our dream of better times ahead will be within reach. Thank you for joining us and your participation in this economic briefing. It is indeed a privilege to present our views on the economy, the markets, and how we can still make money in this tough business environment. I hope to see you all again in our mid-year economic and capital markets briefing. Back to you, Karen, and thank you.
Thank you, Pat. That ends the First Metro Economic and Capital Markets briefing for 2021, entitled Turning Jitters into Winners. On behalf of the First Metro Investment Corporation, First Metro Securities Brokerage Corporation, and First Metro Asset Management Incorporation, my name is Karen Roa. Thank you for joining us. Good afternoon.